He totally understands what's likely to happen and he's prepared. And I think that's what we can learn as individual investors. We can learn a lot from that because we can do all of that as well.
Hello and welcome to the Personal Investor Podcast. I'm here with Tom Stevenson, Investment Director here at Fidelity. And we're going to be talking today about the world's most famous investor. It's fair to say probably many people's idea of the consummate investor. And that is, of course, Warren Buffett. And in particular, we're going to be talking about what Warren Buffett does when markets fall. And Tom, how can we know such a thing? Well, thankfully, Buffett has left us a lifetime of quotes, idioms, and other rules for investors to live by in his shareholder letters, in interviews that he's done, in articles that he's written, and we're going to be highlighting a few of those today. You're here to help me do that, Tom. Now, I can't believe that there's anyone who both A, is watching this video, but B, doesn't know who Warren Buffett is. But in case there is, why don't you give us the 20-second Buffett biography?
Yes, well, I mean, you've said a lot already. He is, the world's most famous investor, and I'm sure most people have heard of him. He trained under another legendary investor, name of Ben Graham, who's sometimes sort of known as the father of value investing. And so Warren Buffett learned his trade from Ben Graham, but then he put it to fantastic use over a very long period of time. So he set up his investment company, Berkshire Hathaway. Actually, technically speaking, he reversed in his investment company into a quoted textile company in Massachusetts called Berkshire Hathaway, or Berkshire Hathaway probably. So that was in the mid-1960s, 1965, I think. And if you look at his shareholder letters that you mentioned, there's a fantastic chart at the beginning of the annual returns from the company and comparing them with the performance of the S&P 500 year by year by year over what is now 60 years now, isn't it? It is the most astonishing long-term performance. Now, obviously, he doesn't outperform the market in every year. There've been periods of time, maybe 2 or 3 years when he's not performed well. But over the long haul, it is a fantastic investment record.
Indeed. And I said that Buffett has left a lifetime of wisdom. You mentioned those shareholder letters to Berkshire Hathaway shareholders. It's really worth people seeking those out, isn't it? I mean, there is some of the normal stuff that talk about performance of what is essentially a conglomerate of investments, some sort of shareholdings, but sometimes entire companies held within Berkshire Hathaway. You get all that company stuff, but it's just the kind of commentary, the wisdom around what the market is doing, commentary on Wall Street, which he sort of sees himself as set apart from, I think it's fair to say. It's fascinating stuff.
Absolutely. And I think, I think it is worth people seeking it out, because even if you're not an investment geek, even if you're not really sort of, interested in the minutiae of investing, people often talk about Warren Buffett's sort of folksy style, and it's true. He talks in English. He talks in a very accessible, familiar way. But within that folksy style is an enormous amount of wisdom about investing, but also about, as you hinted at there, just about the sort of general business environment in America and the world, and a huge amount of wisdom.
Yeah, and while we're talking about sources of wisdom, we should say, Tom, that this is another one of those occasions when we're relying on the hard work of our colleague Richard Evans. Much of what we're going to talk about today is pulled from an article that he wrote this week. I'm going to give people details of where they can find that article. One of the first things that Richard mentioned in his article, Tom, is the valuation method that Buffett uses. Probably not the only one, but the one that he's put his name to, you could say. And it's always going to be useful, whatever markets are doing, but particularly useful when markets are selling off, and if you're looking to buy in again, which I guess a lot of people might be, given what markets have been doing recently. It's called the Buffett indicator. What is it?
Yeah, so it's similar to a valuation measure, which we're all familiar with, the price earnings ratio, which essentially compares the value of a company with the value of its profits, its earnings. It's that ratio. He sort of expands that to look at the overall valuation of the US stock market and compares it with the overall. It's not really the profitability. He compares it with the economic output of the
GDP.
US economy.
Yeah.
So he's saying, let's look at the size of the US stock market, the size of the US economy, and how they compare. And essentially, what he says, it's a rule of thumb. He says, if the size of the stock market is smaller than the size of economic output, roughly speaking, then probably it's a bit undervalued, and it's a good opportunity to buy. If it's much greater than the size of economic output, and he talks about being twice as big at the peaks, then that is a time to worry. So it's a very rough and ready guide to, is the stock market expensive or not? But it's really important to have that guide, because very often we talk about, the stock market looks expensive or the stock market looks cheap, but how do we measure that?
Yeah.
And he has a method for measuring it, albeit a rough and ready one.
Yeah, and people can find it, can't they? Buffett, Google Buffett indicator, you're going to find this and where it is. People record it and keep it updated. It's not going to be so dissimilar from particularly something like CAPE, like the cyclically adjusted earnings ratio. But when one measure shows the market being very undervalued, probably the other one does as well. What I like about the Buffett indicator, though, is it reminds you that all this stuff we talk about, earnings in companies and the market, it's actually attached to the real world, isn't it? And it's to do with the growth of an economy overall. That's only a loose link, but there is a link, and you need to remember that. And I guess maybe that's a product of his sort of great longevity, that he's seen the rises and falls of America actually from an industrial point of view, and that underpins his belief, therefore, in the stock market. It's good for reminding us of that.
Yes, it is good. It's also interesting to look at the actual numbers involved, because they are very, very telling, and they're particularly telling at the moment because he talks about this 200% level, where the size of the stock market is twice the size of the economic output of the US economy. That's actually happened most recently in the last few years.
Yeah.
If you roll back to the time which we often refer to as being a moment when the stock market was, very obviously overvalued, with the benefit of hindsight, true, but the dot-com bubble. On this measure, it was actually a lot cheaper than it has become in recent years. I think it was about 150%.
Yeah.
So the size of the stock market was about 1.5 times GDP. Recently, at the recent peak, it was twice as big as GDP. So I think that's really telling us something about just how stretched the US stock market got in recent times.
Yeah, and I checked before we recorded where it is at the moment. Actually, up to a few days ago, it was 180%, you could say. So pretty elevated. It's important, and it's kind of it might show its worth in the coming months, years, because there's a lot of talk of recession in the United States, and that's a slowdown, a reversal actually of GDP. That's going to affect the that valuation quite a lot, isn't it? And it's going to make the market look more expensive if growth slows down, and it's going to be worth investors watching that.
Yeah, it is. And I think, Buffett's point here is that, in the short term, it's probably not a fail-safe sell signal, but it's telling you something. It's telling you that you really should be a bit more defensive, a bit more cautious at times like that, as opposed to at times when it's the opposite, when the value of the stock market is cheap compared to the economy. Actually, that's when you should really be thinking about getting more involved, buying. And probably you're not thinking that, because that by the very nature of the way stock markets work, when it's down there at those levels, sentiment is depressed, and you are probably not keen on investing. So these numerical guides are really useful because they help you overcome your natural emotional biases when it comes to investing.
Yeah, that's a good point. We'll move on, Tom, to the next bit of wisdom. That was all very mathematical. This is more figurative, you could say. It's what he calls his knower rule, as in Noah and the Ark. The full quote is, "Predicting rain doesn't count. Building arks does." What on earth does he mean by that?
Well, it's a great example, actually, of this sort of folksy style that we talked about, because he puts it in terms which we understand very well or resonate with us. All very well knowing that there was going to be a flood, but what Noah did, of course, was he built the ark.
Yeah.
And so that's what he's talking about. He's talking about preparation. He's talking about getting ready for the next big bear market, because there will be another big bear market. That is the nature. They come along every few years. We've just been through a very small bear market, a 20% fall. Those actually come along every 4 or 5 years on average. In the last 7 or 8 years, we've had maybe 4 of them. I was writing about that just this week. We've had a lot of these bear markets. So being prepared for them is the key. And I think one of the things which he's referring to when he says build an ark is about cash. It's about having cash ready for 2 reasons. One, to protect you from the fall in the value of investments, but also to have dry powder to take advantage of those falls in the market. I mean, he talked he's talked a lot about how he took advantage of situations like the financial crisis. And I remember at the time, he made investments in companies like, I think he made a big investment in Goldman Sachs, for example, at the time of the financial crisis. He's got this fantastic sort of contrarian approach, but it's only possible because of the preparation, the building of the ark.
Yeah, and that's what I would take away from the quote, really. It's the predicting of the rain. It's basically, you can't do it. You just know it's going to rain at some point, right? So calling market tops and bottoms is impossible, but the preparation for when it happens is key. Yes, it's having lots of cash. We'll talk about Berkshire Hathaway in a minute, because that's amazing, the amount of cash it has. But it's also having the plan for what you're going to do with it. So if there's certain companies, investments and assets that you want, what price are you actually, willing to buy at, really? And so when markets fall, I think a lot of people are in exactly this position now. They may have sold off. They may have actually done a bit of market timing, but now their job is to buy in again if they're long-term investors. What's the point? Have they actually thought about that? If they think markets are going to fall, and they do, it's like, well, when do they become good value again?
Yeah, and actually, I think that's a really important point to make about Warren Buffett. And it's partly a reflection of the fact that he's just been around for so long. He's seen all of this. There's nothing new under the sun for Warren Buffett when it comes to investment. He's seen huge bear markets. He's seen wars. He's seen recessions.
Interest rates at 15,
he's seen everything.
20%, yeah.
And he totally understands what's likely to happen, and he's prepared. And I think that's what we can learn as individual investors. We can learn a lot from that, because we can do all of that as well. And this cash point is really important. If you're if you're managing your investments, say in retirement, then the importance of holding a cash buffer is really important, because it means you can stop worrying about the stock market. Warren Buffett never worries about the level of the stock market, and the reason he doesn't worry is because he's prepared.
Yeah, that's right. And through Berkshire Hathaway, we've got he puts his money where his mouth is. Berkshire Hathaway has got and has been building an absolutely vast mountain of cash, hundreds of billions of dollars of it, and partially that's a symptom of the fact that markets have been so overvalued. A lot of the assets that he would like to buy are too expensive in his eyes, and so he's been sitting on cash, and it makes the sort of use case for Berkshire Hathaway quite an interesting one, doesn't it? Because in one sense, the cliche about Berkshire Hathaway is that you're buying a slice of America's industrial sort of future or something. And partially that's true because it's got so many famous, big, established, mature American companies in there, and companies from around the world as well. But because it's also got lots and lots of cash, people will often buy that stock, that Berkshire Hathaway stock, as a sort of hedge for when markets fall, because when markets fall, it can buy, it's going to then improve its performance, or history would suggest it is. and so it actually holds up quite well when market falls for that reason. It's an interesting kind of addition to portfolios. Probably not one that everyone's going to have for various reasons, but it's an interesting kind of has an interesting figure in the stock market.
Yeah, I mean, it makes it quite a defensive investment. I mean, I think that you're right about just the scale of it. When I last looked, I think it was something like 28% of the assets of Berkshire Hathaway are in the form of cash. I mean, what Buffett said actually about this quite interesting quote. That Richard's piece is focused on the quotes. He said, when I look at the alternatives available in the stock market, when I look at what's going on in the world, and I look at the returns that you can get on cash, that actually seems quite attractive to me at the moment. So he's quite happy to wait in cash, and earn his 5% or whatever he's earning on his cash, while he waits for those opportunities.
Yeah, well, let's move on, Tom, to another quote, and this is particularly relevant for those periods after markets have fallen. There's actually loads of quotes. We've mentioned a lot of this sort of thing before, but the simplest is probably this: bad news is an investor's best friend. It lets you buy a slice of America's future at a marked down price. Very, very wise and worth remembering at times like this, I would say.
Yeah, so something that Buffett often or has in the past talked about is this notion of Mr. Market. The idea that that you are whenever you're investing in the market, you're essentially on the other side of a trade from Mr. Market. So Mr. Market will at any time of day or night throughout the year offer you a price for a share of we talk about America's future, the American stock market. Sometimes Mr. Market will be very optimistic, and he will offer you a high price. Sometimes he'll be very pessimistic, and he'll offer you a low price. The thing about you as the investor is you don't have to do anything. You don't have to take up Mr. Market. When he offers you a high price, as he was offering, in the middle of February, you didn't have to buy the US market at that price. In October 2022, when he was offering a very low price because Mr. Market was depressed, you had the opportunity to take him up on his offer. And it's quite a nice way of looking at it, that it's a two-way conversation between two willing participants, buyers and sellers. But it's up to you whether you take Mr. Market up on his offer.
Yeah, exactly. And I think these quotes or quotes like this, they indicate, I think, how Buffett I think he sees investing differently from a lot of people, because and similar to you were describing there, he thinks that the product you're buying doesn't actually change a great deal. He'll say this. You can find the quotes where he'll say, he wants to know what a company does. He wants to know that it's run by sensible, honest people. He wants to understand the business model, and then that's what he's buying. And then the rest is just price. The rest is just movement in price. Whereas the rest of us are like, well, how's this company going to perform? How's it not? It's like, well, no, that will probably stay the same. It's what the market is telling you about the value of that.
It's probably the difference between investing and speculating.
Yeah.
And what he's doing is pure investing. So he doesn't think any differently about buying a share or buying an entire company. And so you mentioned the things that he looks for in a company. So there are four things, I think, from memory. He's looking for: one, he wants to understand the business. Yeah. Two, he wants to know that it's got good growth prospects. And one, the understanding the company helps him have helps reassure him about his judgment about the growth prospects. Third thing is he wants it to be managed by what he calls honest and competent people. And all those three things, don't really change that much. But then the last one is price, and that is the variable, and that's where the patience of the long-term investor like Buffett comes in. even when you've identified those first three things, and there probably aren't a huge number, but there are enough of those around, you've got to wait for that fourth one to come into the right zone. And that's what he's so brilliant at doing. And he'll sit on that 28% of cash for years and probably, take a lot of flack, and people say, why aren't you investing? You're just sitting on cash. He's just waiting. He calls it the fat pitch. It's a baseball term.
Yeah.
And it basically means that, again, when you're batting in baseball, you don't have to hit everything.
Yeah.
You can just let them go by, and you wait for the one where the risk reward of going for it is very high, and that's what he does. It's about waiting for that moment where the risk reward is really favourable.
Yeah, and I'll end the conversation with another quote, a similar sort of idea, but it's a great one, I think. Particularly when I tell you when he said this. It's been an ideal period for investors. A climate of fear is their best friend. Those who invest only when commentators are upbeat end up paying a heavy price for meaningless reassurance. In the end, what counts in investing is what you pay for a business and what that business earns in the succeeding decade or two. Now, we said that in the aftermath, just after the global financial crisis. So, I mean, the mood could not have been gloomier, but not in the Buffett household by the sounds of it. He was very pleased by what was going on.
Yeah, I mean, well, this is the true measure of the contrarian investor, the ability to see the opportunity. So, I mean, to use another Buffett quote on this, it's be greedy when others are fearful, and fearful when others are greedy, and that is exactly the sign of a good. It's very easy to say as well. I mean, we can all say, oh yeah, you need to be greedy when others are fearful. It's so difficult to do, and the people who are really good at it, and you look at Buffett, within our context, you look at someone like Anthony Bolton was very good at doing that. For the rest of us, it's really difficult to overcome the psychology of when everyone else is fearful, not to be fearful yourself.
Okay. Well, that is all the time we have for now, Tom. I'm going to point people to Richard's excellent article covering all these points. Just look for the Markets and Insights section at fidelity.co.uk. That is it for now, Tom. Thanks for joining me.
Yeah, thanks, Ed.